The new financial year starts with similar themes to the start of the calendar year, but tail risks seem to be rising. A quick update on the outlook and why more rate cuts are being factored into the markets here and overseas. The impact of trade wars on the global economy is becoming more broadly visible, with weaker economic data in China, Europe and Japan, who are some of the targets of US trade policy, but also a weaker outlook in the US itself. As a result, the US Federal Reserve appear likely to have finished increasing US interest rates, and the markets are busy guessing when the first rate cut will occur. This is despite US unemployment remaining at 3.6%, its lowest level since the 1960s. And it's a similar story here in Australia. Our unemployment rate is just over 5%, pretty low by historical standards. But the Reserve Bank's estimate of full employment, or the non-accelerating rate of unemployment, when wages growth should kick in, has been lowered to around 4.5%, which is why the cash rate is suddenly down to 1%, and some forecasters are looking for further reductions. The pink line in this chart was the previous estimate, around 5%, near current levels. But the updated estimate in blue is a fair distance away, hence the likely need for the RBA to reduce interest rates even further. A little surprisingly, despite the trade wars escalating and uncertainty around a deal or no deal between Presidents Trump and Xi, risk appetite and stock markets seem to be happy that central banks are back cutting rates and convinced that this will keep capital markets and equities supported. Our ASX 200 has been outperforming many offshore stock markets and finished the financial year up around 7% for the 12 months. And when looking at valuations and PE ratios, doesn't appear expensive based on long-term averages. But the fate of trade negotiations may add considerable volatility to these market movements. Meanwhile, the Australian economy is clearly going through a slower patch, as last month's 1.8% growth rate showed. But that was for the first quarter, and now we have the federal election out of the way, there seems to be an uptick in activity, including in housing. Peak to trough, it has been the largest fall for Sydney and Melbourne housing, and for average house prices, since World War II. But the combination of rate cuts, regulatory easing, and a rise in consumer confidence may be the start of a change in trend. Auction clearance rates have increased, so we'll keep an eye on this encouraging trend. So, despite uncertainty from overseas, and clearly some worries about inflation being too low, there are a few positives, including the price of iron ore and some other commodities at very elevated levels. The trade wars are potentially the largest threat to global growth since the GFC, but when thinking about their impact on Australia, best do so in the context of our largest trading partners, which of course are China and many parts of East Asia. How China copes with trade tensions is critical, and that may depend on a deal with the US or on what China does in the absence of a deal. Either way, our economy will be impacted, and rate cuts here may help, but tax cuts and other forms of fiscal stimulus may be far more effective. And that's the market update from Leveraged.